The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor. Over a long period of years, I have rarely attended a dinner party, including strangers, that someone did not sit down beside me and, after the usual pleasantries, inquire, "How can I make some money in the market?" In my younger days, I would go to considerable pains to explain all the difficulties faced by the one who simply wishes to take quick and easy money out of the market. Or through courteous evasiveness, I would work my way out of the snare. In later years, my answer has been a blunt, "I don't know." It is difficult to exercise patience with such people. In the first place, the inquiry is not a compliment to the man who has made a scientific study of investment and speculation. It would be as fair for the layman to ask an attorney or a surgeon, "How can I make some quick money in law or surgery?" I have come to the conviction, however, that larger numbers of people interested in stock market investments and speculation would be willing to work and study to attain sensible results if they had a guide or signpost pointing the right direction. And it is for them that this book is written. It is my purpose to include some of the highlights of a lifetime of speculative experience, a record of some of the failures and successes, and the lessons that each has taught. Out of it all emerges my theory of the time element in trading, which I regard as the most important factor in successful speculation. But before we go further, let me warn you that the fruits of your success will be in direct ratio to the honesty and sincerity of your own effort in keeping your own records, doing your own thinking, and reaching your own conclusions. You cannot wisely read a book on how to keep fit and leave the physical exercises to another. Nor can you delegate to another the task of keeping your records if you are to follow faithfully my formula for combining the time element and prices as set forth in subsequent pages. I can only light the way, and I shall be happy if through my guidance you are able to take more money out of the stock market than you put in. In this book, I present to that portion of the public, which at times may be speculatively inclined, some points and ideas which have been garnered during my many years as an investor and speculator. Anyone who is inclined to speculate should look at speculation as a business and treat it as such, and not regard it as a pure gamble, as so many people are apt to do. If I am correct in the premise that speculation is a business in itself, those engaging in that business should determine to learn and understand it to the best of their ability with informative data available. In the 40 years which I have devoted to making speculation a successful business venture, I have discovered and still am discovering new rules to apply to that business. On many occasions, I have gone to bed wondering why I had not been able to foresee a certain imminent move, and awakened in the early hours of the ensuing morning with a new idea formulated. I was impatient for the morning to arrive in order to start checking over my records of past movements to determine whether the new idea had merit. In most cases, it was far from being 100% right, but what good there was in it was stored away in my subconscious mind. Perhaps later another idea would take form, and I would immediately set to work checking it over. In time, these various ideas began to crystallize, and I was able to develop a concrete method of keeping records in such a form that I could use them as a guide. My theory and practical application have proved to my satisfaction that nothing new ever occurs in the business of speculating or investing in securities or commodities. There are times when one should speculate, and just as surely there are times when one should not speculate. There is a very true adage, "You can beat a horse race, but you can't beat the races." So it is with market operations. There are times when money can be made investing and speculating in stocks, but money cannot be consistently made trading every day or every week during the year. Only the foolhardy will try it. It just is not in the cards and cannot be done. To invest or speculate successfully, one must form an opinion as to what the next move of importance will be in a given stock. Speculation is nothing more than anticipating coming movements. In order to anticipate correctly, one must have a definite basis for that anticipation. For instance, analyze in your own mind the effect, market-wise, that certain piece of news which has been made public may have in relation to the market. Try to anticipate the psychological effect of this particular item on the mind of the public, particularly that portion of the public which is primarily interested. If you believe it likely to have a definite bullish or bearish effect market-wise, don't trust your own opinion and back your judgment until the action of the market itself confirms your opinion, because the effect market-wise may not be as pronounced as you are inclined to believe it should be. To illustrate, after the market has been in a definite trend for a given period, a bullish or bearish piece of news may not have the slightest effect on the market. The market itself at that time may be in an overbought or oversold condition, which in case the effect of that particular news would certainly be ignored. At such times, the recording value of past performances under similar conditions becomes of inestimable value to the investor or speculator. At such times, he must entirely ignore personal opinion and apply strict attention to the action of the market itself. Markets are never wrong. Opinions often are. The latter are of no value to the investor or speculator unless the market acts in accordance with his ideas. No one man or group of men can make or break a market today. One may form an opinion regarding certain stocks and believe that it will go to have a pronounced move, either up or down, and eventually be correct in his opinion, but will lose money by presuming or acting on his opinion too soon. Believing it to be right, he acts immediately only to find that after he has made his commitment, the stock goes the other way. The market becomes narrow, he becomes tired, and goes out. Perhaps a few days later, it begins to look all right, and in he goes again. But no sooner has he re-entered it than it turns against him once more. Once more he begins to doubt his opinion and sells out. Finally, the move starts up. Having been too hasty and having made two erroneous commitments, he loses courage. It is also likely that he has made other commitments and is not in a position to assume more. Thus, by the time the real move in the stock he jumped into prematurely is on, he's out of it. The point I would here emphasize is that after forming a definite opinion with respect to a certain stock or stocks, do not be too anxious to get into it. Wait and watch the action of that stock or stocks market-wise. Have a fundamental basis to be guided by. Say, for instance, a stock is selling around $25 and has been holding within a range of $22 to $28 for a considerable period. Assuming that you believe that the stock should eventually sell at $50 and it's $25 at the time, and in your opinion it will sell at $50, have patience and wait until the stock becomes active, until it makes a new high, say around $30. You will then know that market-wise you have been justified. The stock must have gone into a very strong position, or it would not have reached $30. Having done so, it is altogether likely that it is on its way to a very definite advance. The move is on. That is the time for you to back your opinion. Don't let the fact that you did not buy at $25 cause you any aggravation. The chances are, if you had, you would have become tired of waiting and would have been out of it when the move started. Because having once gotten out at a lower price, you would have become disgruntled and would not have gone back in when you should have. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. Later on, when some examples of my trading operations are given, you will notice I made my first trade at the psychological time. That is, at a time where the force of the movement was so strong that it simply had to carry through. Not on my operation, but because the force was so strong behind that particular stock. It simply had to and did go. There have been many times when I, like many other speculators, have not had the patience to await the sure thing. I wanted to have an interest at all times. You may say, with all your experience, why did you allow yourself to do so? The answer to that is that I am human and subject to human weaknesses. Like all speculators, I permitted impatience to outmaneuver good judgment. Speculation is very similar to playing a game of cards, whether it be poker, bridge, or any similar game. Each of us is possessed with the common weakness of wanting to have an interest in every jackpot, and we certainly would like to play every hand at bridge. It is this human frailty, which we all possess in some degree, that becomes the investor and speculator's greatest enemy, and will eventually, if not safeguarded, bring about his downfall. It is a human